trying to buy these home builders has not paid off unless you're a good trader. And even there, you to get the bounces, you have to catch the timing exactly right. Home builders are a good early cycle play, but I don't think we're there yet. And
Mhm.
so let me shift, and then I'll hand it over to you, Robert. Let me shift over to just talking a little bit about financials because they're also a good early cycle play, but they're showing continued deterioration. So let's talk about the XLF because that's an index that I've torn apart in my writings on Wall Street Beats. It's the broad financial services index. It has a lot of subcomponents like insurance, private equity, payment companies, and then credit card companies, and then the big banks. And I've been talking about how the insurance companies started to roll in the summer of 2025. And just to remind people, insurance stocks let us down in 2007 ahead of the great financial crisis. They peaked in May, June of 2007 and started rolling over. And we've seen a very similar analog here in 2005, where insurance stocks, I think, and we've had this rotation where insurance stocks are weak for a little bit, then private equity took over, then payment companies like PayPal took over, then credit card companies like Capital One took over, and now it's the big banks, the Goldman Sachs, the Morgan Stanleys. And this morning, Morgan Stanley announced that they were going to start to gate some of their private equity, you know, investments. And that stock was off 4% last I looked.
Mhm.
So I've been writing about how we're moving towards a liquidity event by this spring. That's also in my writings on Wall Street Beats. You can go back and look at that. And I think that's now very visible that we are having a liquidity events in these private equity names. Within the XLF, I think we're going to go visit those April Liberation Day lows of 225. Um, and, so that's another 15-20% down from here. Right now, if I were to short something today, it'd be the insurance ETFs, IAK ETF or KIE ETF. Within the IAK, two names that stand out: Progressive (PGR) and AIG as interesting shorts.
Mhm.
So we've seen this rotation. Where one week it's the big banks, the next week it's the card companies. I think insurance stocks, led by property casualty, where pricing has probably peaked and is now deteriorating. Insurance stocks are going to have another leg down. So that's where I'd be placing my money. I remain very bearish. I've been very vocal about being bearish for the last month and a half, 2 months. So I think you have to wait to the spring to find a good investment opportunity versus just a
Okay.
trading balance. So I'll
Now,
leave it
the
there.
private credit news is really what's on a lot of people's minds these days because of the announcements and the shenanigans that have been perpetuated there over the last 5 years or so. You wouldn't buy any of the stocks that have been down and crushed on this private credit, beginning of debacle. Let's call it. It's way too early for that, you think, or would you try to catch a bounce?
I think it's too early. I mean, unless you're a really good trader. I mean, they are oversold technically, so they could
Hmm.
bounce at any moment, but it's going to require market stabilization or market bounce for that. And then you have to tier them. I mean, I do company reports. I don't publish company reports on Wall Street Beats. Those are for my client base that pay
Hmm.
me well. But if you were to tier them, I would say Apollo is probably the best of them. And interestingly enough, Apollo now is saying that they are going to publish an NAV every night to give a sense of, the quality of their portfolio. That's going to put pressure on some of the second tier players that, probably can't do that because they have illiquid, discounted securities. The three names that I've been writing about that I've highlighted are more vulnerable because their business models are Blue Owl, which is obvious to everybody now,
Hmm.
Hercules Capital, HTGC, and then Hamilton Lane, HLNE. So those are the names I certainly wouldn't touch. And if I go back to my 1907 analogy, I think back in 1907 there were some very large trust companies like Knickerbocker Trust Company of America, that didn't make it. Actually, Trust Company America was finally bailed out by J.P. Morgan, but Knickerbocker failed, and I think you're going to see the same thing. There's going to be one or two or three of these very large private equity, visible private equities that don't survive the cycle, but by and large, most of them will. It's just right now the stock prices just aren't appealing, and if you're a long only investor, you can't figure out what NAV is on any of these. How do you calculate NAV? Because the opacity of their balance sheets is
You don't know what you own, right? Exactly. Sometimes the
so
companies don't know what they own, right?
it's true. And
Well,
you know
the blue shareholders are definitely out. Noel,
yeah,
out.
yeah. And the other thing that I've written about, and I think it was actually picked up by Grant's Interest Rate Observer. I have a tremendous respect for Jim Grant. He has a great perspective on history and financial history specifically, but was that we were moving towards a liquidity event. And that was because I expected that the banks would start to pull back from supporting these private equity, private credit names.